So why can you beat the professional hedge fund managers that have billions of dollars? In this video, I will show you what the professionals don't want you to know and the advantages that you have over them. Hey, how's it going? On this channel, you will learn the steps I took to go from trading to the full-time job to trading as a full-time job. So if you're new here, consider subscribing. And today, we're talking about how you can beat the professional hedge funds. So the advantage that we have over these big funds is that we have a very small portfolio size compared to them. Most personal investors are trading well under $1 million, and these huge funds are trading tens to upwards of $100 billion. So if they want to have a position in a stock and they just want to allocate 1% of their portfolio to that stock, they have to put $1 billion into that stock. Now, putting $1 billion worth of money into just about any stock at once will cause it to skyrocket in value. And for us trading, let's say a $10,000 account, if we wanted to put even 10% of our portfolio into a stock, that would only be $1,000. And in most cases, that will just be a handful of shares. Now, for a company like this, if they were going to buy $1 billion worth of shares, that would be a ton of shares. Let's say on a $60 stock, that would be over 16 million shares. Now, most stocks will only trade maybe even 1 million shares a day. So that is the huge issue that these big funds have with buying or selling a position. If they want to just buy a position of just 1% size, it can take them weeks or months to buy that whole size. Because if they were going to buy 16 million shares at once, when a stock on average only trades 1 million shares a day, it'll have a huge effect on the stock. To illustrate what I mean, this is what a stock chart could look like. Normally, on the left side, it could be trading just up and down in its average range that it normally trades with those million shares. And if a fund came in and bought 16 million shares at once, the stock would skyrocket like this. Even if it's a large cap company, the amount of inflow of buying pressure will just make these stocks skyrocket. And what this does to the hedge fund is it makes their cost basis really poor. Now, what that means is if they started buying at somewhere like 57 and they forced the price of this stock all the way up to 70 and they were buying shares all the way up, this would make their average price that they bought somewhere around 63 or 64. And that's essentially making it so they have less profit potential. Their profit potential is essentially when they sell above 64 instead of the initial price that they bought at of 57. This is essentially one of the major differences in how we can profit versus how they can profit. We could buy at that 57 and catch the whole move up to 70, and they can't do that. They would be able to buy slowly and catch some of the move, allowing us to have a larger chance of profit potential than them. Because these funds have to take a few months to buy a stock, they have to start buying really before they would want to and after they would really want to. And what this would look like on a stock chart, as the stock is trading down, they would actually start buying it before the potential bottom. And then as the stock slowly bottoms, they're still buying and accumulating their position. And then once it starts going up, they have to essentially chase the move because they're still trying to fill their position. And then on the flip side, when they want to sell, they actually have to sell earlier than they would want to. And then they sometimes sell right at the top, but they would also have to sell later than they want to, essentially making them have to miss out on profits on both ends. And so that makes it so their profit zone and then really the area that they make a profit is not really the bottom and not really at the top. It's kind of in the middle. They miss out on a large chunk of the potential move that they were trying to get. Now, for us as small investors, we can just buy right at the bottom and sell right at the top. And so that gives us that huge profit potential compared to the big funds. Now, I don't want to mislead you and say that you're going to be able to buy exactly at the bottom and buy exactly at the top and get 100% of a move. But the idea is that when you see a stock that you want to get into and you see really good signals that say, oh, this stock is going to make a lot of money for me right now, you can buy into it instantly. Those funds, they have to wait a long time before they can get their position size of maybe even 1%, where you could instantly buy a size of 10% in your portfolio. And then as soon as the stock starts to look bad and not in your favor and you want to cut your position and take all your profits, you can do that. And the fund, again, they can't do that. They have to slowly sell their position over a few months if they don't want to lose out on profits. Now, this is what can also kind of cause a crash, is like in 08 with the huge news of all the housing market having the issue, that the market started to plummet because all these funds, they didn't want to wait months to sell their position. They wanted to sell it right now. And that's what caused the market to really have days where it could be down 5 or 10%. A lot of these funds, because they are managing so much money, they will have to be highly diversified. Now, a big goal of theirs is to really just keep you around because they want to collect fees on the money that they have. If they even collect 0.5% of the money that they manage as a fee for $100 billion, that is a ton of money. So as long as they keep you happy and don't lose your money and maybe make you about 10% a year, most people are going to be happy with that because they don't really realize that they can make a lot more money. So these funds, they will only have about 1 or 2% in a fund, in a stock at one time. And so that really hurts their gains in a lot of ways, because if they want to be highly invested in tech, they have to invest in maybe 10 or 20 different tech companies. And not all of those are doing very well. Usually there are 1 or 2 companies that are just killing it for maybe a few years, and that is where most of their gains will be from. But if they only have 1% invested in that stock, it's not really going to grow the portfolio as a whole much. Now, as a personal investor, you can invest really as much as you want. And I wouldn't say that's necessarily smart to maybe invest 100% of your money in one stock, but plenty of people definitely have maybe 10, 20, or 30% in a stock with the idea that, well, you can sell it at any time when you see that, you know, some parameters that you have set beforehand are being met to sell a stock. So if you see that, you know, maybe Amazon over this last few years has done insanely well, and you want to put 30% of your portfolio in Amazon, you're going to get a lot of growth from that one stock compared to when a hedge fund, they can only have 1 or 2% of Amazon. Just little tweaks like that make a huge difference in the profit potential that you have. And you don't have to necessarily be a day trader or trade crazy options or futures. Even if you just do normal, simple investing of buying and selling a stock every 6 months, a year, a few years, you can still make 20 or 30% a year if you are lucky and pick the right stocks. Hey, thanks for checking out this video. If you want to learn more about the stock market, make sure to check out any of my other videos or hit that subscribe button. Now, if you have any questions on anything I went over in this video, make sure to ask them in the comments below, and I hope to see you in the next video.